Thank you, Paul. Good afternoon. So our next session is Industry and Economic Outlook, which will be moderated by Jay Fierro. So Jay is the president and CEO of Capital Automotive. Now, I've been with AutoTeam America for quite some time, but not as long as what Jay has. Where is Jay? Oh, there he is. So Jay has actually been, so this is our 29th annual Dealer CEO CFO Forum, and Jay has been with us since forum number 1. So this is his 29th time he showed up for our conference. So thank you, Jay. So I would like to introduce our speakers. John Murphy, Bank of America Merrill Lynch. John is the managing director and the lead U.S. auto analyst in equity research. He advises clients on investments in automotive manufacturers, suppliers, dealers, and related businesses. Key pillars of his research portfolio include Car Wars, Who Makes the Car, the Dealer Manual, the Big Bang Series, and the annual New York Audit Summit. If you've been to these before, you know that John has been with us for quite some time. So thank you, John, for joining us again. Our second speaker is Jonathan Smoke of Cox Automotive. So Jonathan is the chief economist for Cox Automotive and leads Cox Automotive's Economic Industry Insights team, which tracks the economy, new and used vehicle sales, supply, prices, retail and fleet demand, consumer credit and auto financing, as well as other dealer sentiment to understand the key trends impacting both the wholesale and retail markets for vehicles. So thank you, John, for joining us. Jay, I turn it over to you.
Thank you, and really appreciate the introduction here. And I want to thank everyone here that made it today. You know, there's a lot of dealers here. As you know, we had to shut down registrations. You might have seen sold out front on the billboard. And we called Jerry Jones and we said, you wouldn't have a facility available, and he didn't think he was gonna have that available, but maybe next year we're gonna have to plan for a bigger place than this, because just outstanding participation by all of you. But it's really our speakers and presenters and agenda the reason you showed up, so thank you. So I'm gonna start off to John Murphy, and we've seen Tesla be in the press daily, like really even more than once a day, and whether it's their tiny little market share that gets them this, they're outrunning the coverage, and I call it press coverage, not football coverage, constantly. And it's just a tiny, and they do have a little bit different model. They do have a different product offering. And they just had earnings, right? And certainly you know a lot about that. But I'm looking for, maybe the biggest headline right now is the price cut. So, you know, it's a multi-part question, and I think Jonathan's going to follow in eventually too. Sure. But it's the price cut at Tesla. How does it affect other OEMs? And eventually, where does it trickle down to the dealers, the franchise dealers?
So thank you so much for having me. It's always great to come here. I love hearing everything you guys have to say too about the business. So it's always great to rub elbows with you. So thanks for having me. On Tesla, the price cuts are multifaceted. You could argue, that their competition is ramping up. You could argue that demand has softened a little bit. You could argue that they might want to dip under the caps for the IRA, so they qualify on MSRP on the Model Y and the Model 3. But the reality is, if you want to grow at 50% a year, and you did 1.3 million units last year, you got to open up the market by going down price, right? You can't sell 2 million unit, or you're unlikely to sell 2 million $55,000 vehicles globally. It's a lot easier if you drop that price to $45,000 on average. So I think that's really kind of the key motivating factor is to drive growth at lower price points, and you wouldn't be able to do it otherwise. The issue here is that he doesn't have the Model 2 or Model C, whatever they're going to call the product, below the 3 or the Y until 2025. So, although he said last night that they have 2x the demand versus their capacity or what they can actually produce. So you wonder why you would actually cut price as much as you did if you had that kind of environment. But there's risk that he might cut again next year before that entry-level product comes in at a lower price point. So that's certainly something we're watching for. But also very curiously, last night they said the Model Y, they were taking pricing back up a little bit there. So it's, he's kind of monkeying around with the pricing here, but I don't think that price increase was that much. But it's a pretty, we've never seen a big cut like this in one fell swoop in the industry. I mean, the GM price power was 01 to 07. It probably would have been similar in magnitude, and he did it all at once. As far as the bleed across to the rest of the industry, I'm sure Jonathan's got some great insights on this on his data. But I think on Wall Street, people are kind of not too concerned about GM and Ford because they don't have product that goes head to head with the Y and the 3. Yes, and the X not really either. There's a view that they're kind of with their truck portfolios. But the reality is that kind of pricing action bleeds into markets generally. It doesn't stay isolated. So it's certainly something we're watching and we're concerned about. We have pricing down in our GM model and Ford models down 5%. And then with the cuts and the grosses that we have in our dealer models, about another 5%. So we have pricing down about 10% in total average transaction price this year. So I think we're being reasonably conservative in a sort of our traditional side of the business. We got to be careful; it might be worse than that. But that's kind of how we're thinking about it right now.
So is this historically the deepest cuts by an OEM that you know of any?
In one fell swoop, we've never seen somebody cut pricing this much in one fell swoop. No.
So John, what do you know about when that happened in the past, and what do you see today?
I don't think we have seen this situation in the past, and my take on it from a competitive standpoint is this was destined to be a year where competition was really coming to Tesla for the first time. And we've got, outside of their update, product refresh due probably third or fourth quarter. Was there an update on that schedule too for the Model 3?
They're actually going to announce something on March 1st on the entry level product, but as far as the other stuff, it's not. I mean, it's the same product. Yeah.
Okay.
Yeah, they're going to keep rolling the same product.
I mean, basically, you've got a product that is compared to all of the 27 new product launches that are happening this year. It's much more exciting and fresh in the market, but you've got a price that's really at the high end of segment, and I think it's a reaction of the potential demand in the market. We had Alan this morning talking about pent-up demand, and I think it's an important parallel to this fundamental question. I believe that the basic math that Alan presented to you is essentially right, with one very important variable. If anybody remembers Economics 101, the demand curve is downward sloping. So what does that mean? When prices go up, you sell fewer of those units. So I think those pent-up demand calculations and the potential for Tesla to sell are basically much harder to achieve at today's prices and today's interest rates. This is not 2019 anymore, so using what we were doing in 2019 as a base is, basically creating demand that I'm not sure the consumer can step up and sort of deliver on that activity. So I view this as the first salvo of what is going to be a very entertaining couple of years as there's real competition in the electric vehicle space. Of course, if the price cuts keep, we should be seeing cascading declines impacting the used car market of those vehicles too. Electric vehicles, which have been principally Tesla over the last 5 years, basically have enjoyed improving wholesale price performance, and generally that's been positive for the category. But if you suddenly have discounts coming not just from Tesla but from other manufacturers to be competitive, then bang, we're in the early stages of seeing a return to incentives and price competition. But we've got a long way to go. We've had 18 straight months of the average transaction price being above MSRP. And so there's a big gap to get back to what price dynamics were back in 2019.
But with that, and not to just be on a downer, we'll be on the upper too on a few of these questions, but what happens to residuals when the transaction prices decline like this? And what does consumer equity look like, and trade cycles? How are these all impacted?
So there's no question when you start to have price discounting in new, it cascades into the used market. We refer to it as the waterfall effect. But essentially, you should have, if the brand new vehicle to drive off the lot is now worth $7,500 less, its corresponding 0-year used vehicle is now worth $7,500 less, further down the waterfall. Over the last couple of years, we've had some normal pricing dynamics totally distorted, because it's still the case that for many of the most popular models in the country, the used brand new version, current model year of that vehicle is actually still worth more than what many dealers are selling those vehicles for, because of the scarcity that has existed in the new vehicle market and how much demand there has been for nearly new vehicles. But we're close to the end of that. I think we're a few months away from seeing that no longer being the case. But residuals are still very high. We're looking at aggregate numbers that are certainly down from peaks that we had at the very beginning of last year. But you're looking at a typical 3-year basket of vehicles right now that has close to at least a 75% retention value, and yet the residuals that are being written on new leases are barely off of the 50s that they used to be, which is precisely why lease offers are horrible and consumers are walking away, electing to purchase some other way.
Anything to add to that, John?
No, I mean, I concur. I mean, I think the interesting thing is to watch how this price spiral impacts Tesla's ability to sell new vehicles, right? I mean, that equity that comes back is going to be lower. So that's certainly something I'm not sure Elon's tuned into quite yet. I think some of his existing customers are screaming bloody murder that they've lost $10,000 off the bat. But that's something we're going to have to watch for the demand function for them.
Of course, when dealers had great grosses and transaction prices over MSRP, factories are quick to adjust, right? The cost to the dealer, right? So there's a little transfer of that profitability that they're trying to get their hands on. We've experienced production interruption in a number of ways. We all know all those different reasons. But where do you think we are today with production for the US market versus pre-pandemic capacity? And I'm going to ask John this first. And where are we going and how's it ratcheting?
So what we've been hearing from folks in Detroit for the past 2 years is, thank God the semiconductor industry is causing all sorts of problems in the supply chain, because if it wasn't them, it would be us. Because we're having a hard time. This is coming from the tier 2 and 3 suppliers, not necessarily the tier 1 companies that we cover. And the major issue has been labor. But then the second issue is access to working capital, as they need to rewind their business back up, or if they needed to. What we're starting to see is semiconductors become a little bit less of an issue, although they're kind of still popping up here and there. Is that sort of patchwork quilt of issues in the supply base is kind of rising up and causing problems. And it's a game of whack-a-mole. It's a little bit less identifiable than just your standard, hey, it's a semiconductor industry issue. It's injection molding for an IP, or a door latch or something like that that's not getting done. So I think we're going to see disruption during the course of this year continue, and volatility. I mean, Magna, one of the third largest supplier on the planet, just announced that their EBIT in the fourth quarter would be 40% lower because of volatility in schedules in the fourth quarter. Then 40% lower than expected, not on a year-over-year basis. So I mean, it's still around. I wouldn't imagine that you're going to get more than 5% increase in production, this year in North America. So I mean, your cap util is still, in the 80-85% range. So it's still pretty low. You could produce easily, another 15 to 20% more units that you did this year if the supply base wasn't challenged in many, many ways.
How long will it be?
Well, I mean, I think it's a question of how hard the automakers press to fix it. And I think this is one of the things 2.5 years ago, when the supply chain issues really arose. You had every single management team at the automakers run around with their hair on fire trying to figure out the supply chain issues. But then they started printing record profits, and they got a little bit less concerned, and they weren't running around as much and as hard. So I think, as long as they keep putting up these record profits, they're not going to push super hard to fix the supply chain. I mean, 5-10 years ago, they would have been continuing to run around with their hair on fire. So, I think they'll push. They want the supply chain to be worked out. It would be good for everybody if you had a smoother supply chain. But the reality, that's coming up right now is that, there's this question of where buffer stock should be in the industry. And there's this whole idea that suppliers are supposed to hold, more buffer stock to help deal with this over time. Pre-COVID, we had buffer stock, and it was on your lots, right? Kind of, I mean, that's to be a little bit of a wise guy about this, but they're trying to push the suppliers to have more and more of a buffer stock, and I think that's the direction they're going to go in. I mean, inventory is ratcheted up, but I don't think they're going to let it get out of control, even if the supply base comes on. So it's going to take a while.
So they're going to run their business better.
On the margin, yes, until Elon, rolls the, atomic grenade in the room on pricing and maybe does it again and again and again. So, yeah.
Okay. So Jonathan, I know you track a lot, the new and used car inventory, days supply. I don't know how much you have to share of the history. These people manage those inventories constantly. But where do you predict that, in the short term this year and maybe next year, we don't have to go very further than that, where we're headed?
We're definitely past the inflection point of the worst of the supply shortage in new, and we would expect to see continued improvement. But I would add to what John was saying to say the prospect of a recession and a prospect of not being able to maintain the level of profitability that the manufacturers enjoy means that I believe it's very possible that we'll see them pull back. So instead of pressuring, because if you're the domestics, why pressure and push, and especially when one of their biggest challenges is labor, when UAW contracts are coming up, this is just not an environment to do it. I would argue if I were in their shoes as a manufacturer, I would rather sell 13.7 million with no incentives than to sell 15 million with the same incentives I had back in 2019. And I think it's a really valid choice. Maybe in some segments it's not, like in electric vehicles, but I think for the vast majority of the units, we could be seeing a pullback. I don't hear people talking about the reality, but every recession we've ever had, production has declined, and typically declined by something around the magnitude of 15% or more. Why would this time be different? And the answer is, well, we're already supply constrained. We're already down 10% last year, but yes, but think of it in terms of profits. And the reason why they pull back in a recession is because they don't want demand to deteriorate further to reduce the profit picture even more. So I think there's that element to the equation too. But then you were asking more broadly about used. And used, last year for most of the year, on the retail side, we were oversupplied. Basically, most dealers geared up to have a strong tax refund season last year, and we just never saw the potential come out in the marketplace. So we were chasing down an appropriate level of days supply from January 1 last year. And there's multiple reasons why last tax refund season was a dud, but one of them was the IRS was so far behind in processing tax refunds that even by June, they had only processed about 3/4 of them, when typically we're completely done by the first week in May. So we just didn't have the money landing. And unfortunately, the money, when it did landed when gas prices were at record highs and inflation was really zapping consumer confidence, and we just didn't see the typical strength that we see in the used vehicle market. So dealers were then managing to have an appropriate level of inventory for a slowing market, and especially that was when wholesale prices started to decline. And we were chasing those numbers all year long. But by the end of the year, we were there. Days supply was back at a normal level, and by December, we were actually lower than 2019 levels on days supply. And we're really down now in used vehicle inventory. January, depending on which subset of the metric you look at, it looks like we've got the lowest inventory ever in the month of January on dealer lots. So that means just a modest uptick in retail demand is going to ripple through that and really look like a strong market. And so far, I'm always hesitant to give you a view of the year based on the month of January, which is the weakest month of the year volume-wise, and one that isn't always predictive of what's coming. But January has started well. We're seeing growth year over year in used retail sales. The dealers I've been able to talk to so far are basically saying that, yeah, the January numbers so far are pretty strong on the used side. So the supply is in balance, and therefore being able to be influenced by any uptick or downtick we see in demand. We're pretty pessimistic about this year's tax refund season because this year tax refunds will be down. A lot of what boosted last year's tax refunds, and even though it was disappointing in terms of how it impacted the used retail business, we had record tax refunds last year, and this year we're going to see declines. And a lot of consumers are going to be negatively surprised because the declines are a result of one-time tax changes that applied to calendar year 2021 only. So there are a lot of folks who got income tax credits, child tax credits, child care tax credit expansions that really juiced refunds last year, and they're going to be down year over year. And meanwhile, we're expecting interest rates to keep inching higher until ultimately peaking roughly around tax refund season. Then that just doesn't sound like a strong time. So I think what dealers have been doing, what you have been doing, what the best folks in the industry have been doing to really reduce inventory exposure and buy only when there are opportunities and real demand has been the right recipe. Or as Dale Pollack, one of my colleagues at Cox said, the focus is 30-day turns, and turn, baby, turn on anything you get. Buy it right, price it right, and those dealers are really the dealers who are seeing success right now in January.
Yeah, I would just say one thing. Jonathan actually mentioned something that's very important about the UAW. That contract expires in September, and based on what we're hearing, it's probably going to be Stellantis / the former Chrysler that's the lead that the UAW picks. And there's a high likelihood there's a strike. So, I mean, if you're talking about sort of supply disruptions, again, be ready for an extended strike. At Stellantis is probably where it's going to start. Might be GM or Ford, we'll see. But it's going to be a pretty contentious year because the UAW has been playing ball for a while, and there's a lot of friction inside the UAW, and it's unclear who the actual president is right now. They have a runoff in February. So, if you're a Stellantis dealer or GM or Ford dealer, be ready for some disruption towards the end of the year in the third quarter.
Strike, I don't like that. Yeah. So in following through on the production recovery, but when we get to that point, and if there's a strike and it's disruptive to one of the manufacturers, I think production in the past has likely been advantageous to whoever could. But when we have supply that exceeds demand, and I know we saw a couple million totaling like nearly 10 million units of pent-up demand, right? Assuming pre-pandemic levels were where we should have retailed the last couple of years. If the supply gets beyond the demand, what does come first? Production cutbacks, or do one of these OEMs begin back into the incentives?
I mean, my bet is production cutbacks.
Okay.
Because again, there's plenty of reasons why not to be super aggressive. And I would argue it was already starting to happen for North American production in the final quarter of last year. If you look at the data that Wards puts out and you annualize the production that we had by month last year, we had a much higher run rate of production in North America in July and August. And at the end of the year, it was dramatically already starting to slow. And guess what? Last year, Stellantis, basically around the middle part of the year, July, I believe was the month, was the first manufacturer to start increasing incentives. But they were also, by our day's supply data, very close to normal at that point. Well, essentially, they cut back production. They completely shuttered one of the Jeep factories and lines, and since then they've pulled back on the incentives. The day supply is still relatively high compared to others, but isn't getting worse. And so if you see those manufacturers who are the ones who are more likely to overproduce and go to heavy incentives, and they're the ones pulling back, then the rest of them, which are increasingly facing more issues, especially when you look at the Asian production and the Asian brands and many of the European brands. It's not even a possible discussion right now. They can't be at 100% capacity of what we had in 2019 because there's still issues throughout their base in both the labor and the supply chain.
Yeah, I think one thing to add to that, is there's two times in history, one more recent from 17 to 19, where demand was fading and the industry was cutting production. So I mean, there was a recent pre-COVID moment where the industry was pretty disciplined. I think that the second thing, and this is something that we deal with with a lot of investors that want to believe that pricing in the industry is always horrific and conflate what happened from 2001 to 2008 in the death spiral of Keep America Rolling. It started in September, after September 11. GM started that. And Rick Wagner rode that down into the bankruptcy of GM in 2009. You don't have any single company that's got a cap structure that's totally screwed up, that's got a massive underfunded pension, a massive underfunded healthcare liability, the rest of the cost structure that's screwed up, and a product portfolio that's dated, and a management team that has no idea how to manage the company. So you don't have that kind of setup of somebody that's that screwed up or that horribly structured in the industry right now. It doesn't mean that pricing is going to be perfect, but you don't have anybody with those kind of distorted motivations and just doesn't understand how to run their business in the market, obviously, to us right now, right? I mean, it's just nothing like that right now.
And likewise, we have other movements, other themes that are happening that I think fundamentally also question whether production is going to get back to 17 million. One is the shift to electrification, which is retooling, closing some plants, starting new plants, looking at more joint ventures rather than kind of sole product investments. And I think net, that alone would take some capacity out of the total global production that feeds the US. And the second is deglobalization. We are effectively moving away from the absolute lowest cost, maximum output model that dominated the industry since NAFTA. And I think that will pull capacity out. I would wager that there's a possibility that within 5 years, we're still not going to get back to 17 million being delivered to the market. It will be more supply constrained than we ever have been. Now, the economist in me, if you ask me that, will we be disciplined forever and will it be supply constrained? Heck no. This is a fixed cost, extremely capital intensive industry. These are unique circumstances that created this opportunity. So I would think of it in terms of time frames. In the near term, I'm seriously doubtful that we can deliver 15 million units this year. 10 years from now, can we see a world where there are no incentives and the average price is 7 to 8% below sticker? Most likely, because that's what a capital intensive does. But in the meantime, between now and then, I think especially over the next 4 to 5 years, it's likely to be the most supply constrained it ever has. And the used market follows the new market in lockstep. And we are just at the beginning stages of what is going to be the tightest wholesale and used retail market that we're going to see for at least the next 3 years. So on the one hand, transactions are going to be down. Our forecast is for retail sales to be down roughly 1% year over year, and that's tough to see. But on the other hand, it means that some of the positive pricing dynamics are going to remain in place, just not as beautiful, as exciting as those GPUs were last year and the year before.
Well, the awful words of recession, interest rate hikes, inflation, customer, even employment trends, right? Those all come to play. 84-month loans, 18-month leases. Are those the beginnings of making impacts in the business?
Well, you definitely have a lot of moving parts, and yes, I've seen more of the concern on 84-month loans coming up now. We're not seeing that in the origination. We're seeing just the opposite of it. 84 months were a bigger thing 2 years ago. And so yes, they're represented in the loan base. So when you do a report from Equifax or Experian, they're looking at the installed base of loans. And those people with 84-month loans, many of them are on full-size pickup trucks. And by the way, do I think that represents a big mistake on the consumer? No, the average consumer holds a full-size pickup truck for life. So having an 84-month loan on one of the most expensive vehicles is a logical, practical way to manage the payment amount. But what I meant by we're not seeing it in the origination data, we started to see credit tighten in the second half of last year. So we've actually seen a declining percentage of 72-month and beyond loans happening pretty much every month since last summer. And that's especially true for credit-sensitive borrowers. So the bad news is it was one of the ways to control affordability, and it's now gone and getting harder to do. And so the affordability challenge is becoming even larger for consumers. But on the lease side, I think the lease issues are really tied to the lack of incentives and the lack of adjustment in the residuals. And I didn't think of it until today, Alan, but your presentation about how do you value companies based on historical revenues and profits is exactly what's wrong with leasing. Because the lease residuals that are being written want to go back to 2019 averages. But it's not 2019. No, it's not going to be 2020, 2021, or 2022 either. But we're not back to 2019 used vehicle values. So in essence, what you're asking the consumer to do is overpay for the depreciation they're not going to have on the vehicle over the next several months. And to the rational consumer who has cash and other options, which is most people who lease, they're basically saying, I'm not taking that offer. And as a result, lease penetration has plummeted. I do think 18-month leases are an interesting idea. It's a way to play that gamble, reduce the risk, do something more aggressive, but we also need to see incentives come back. The old lease residuals, on average, always produced negative equity on the loans. That was because there was money put into them to make the lease deliberately more attractive. And there's been none of that over the last 2 years. And we really need to see that come back for us to see that lease offers make sense again.
Anything to add?
No, I mean, I'm shocked that the captive fincos have been so disciplined on maintaining that roughly 55% resid. In the past they would have, if they would have gone back up to 75 to 80 and written leases all day long. The issue is they don't have the supply to clear, so they don't have to do it, and they could put the residual risk onto the consumer as opposed to assuming it themselves. So, from a financial standpoint, and looking at the companies, they've been much more conservative and hopefully, protect themselves from any risk that their residuals, come down significantly over time. So it's a good move from the automaker side, from the finco side, not necessarily from the automaker side. But there's no incremental units to really sell. So, why play the game if you don't have to? I think it's from the company's perspective.
Well, I'm sure our audience is thinking of some questions they'd like to ask our guests up here. So I don't know if there's someone with a mic that's going around yet, or raise a hand and we can get a mic over to you.
You can throw tomatoes too if you want, right?
Do I see a hand? Any questions? Okay, so how about wild cards?
Sure.
Upside and things we're not thinking of that could be surprises? What are the wild cards in the future here?
Well, Jonathan's more the economist. I'm more of a stock analyst, but I'm wildly concerned with what the Fed is gonna do, and if they screw things up here and they push too far, I think that the risk is fairly low, but not zero that we see something like 2008 occur for the auto consumer again. I'm 2009, right? When you were in 2008, you had a 13.2 million unit SAR. In 2009, you had a 10.4 million SAR, and that kind of drop off the cliff to something that is abnormally low and kind of a real shock was because auto credit froze. All sorts of credit froze. But with rates jacking up and getting extremely high, it could effectively cause credit to freeze for most auto consumers, and that could be a real risk here. So that's a wild card to keep an eye on. We're at 14.3 officially for our U.S. Sales rate this year. That includes retail and fleet, but that could create some real downside risk if credit is effectively freezing because it becomes so expensive for consumers and they just balk and hold on to their vehicles for longer. So I think that's a wild card we got to be careful of on the downside. it's not so wild. It's
Yeah, I would totally agree with that being probably the most important wild card in the near term. And Fed meeting next week, you know, we've got a few more movements on that end that will ultimately likely decide if we are pushed into a recession or not. And as I mentioned earlier, if we have a recession, and even if things are just simply looking like we're going into a recession, I think manufacturers will pull back, which will certainly impact the whole supply discussion that we were having. But I think there's one other wild card that is interesting, and I haven't heard much discussion about this yet. But what we observed happening in the second half of last year, on the finance side of things, was a substantial uptick in cash transactions, especially in the new vehicle market. We saw it move by a 7% share from traditionally only being about 14% of total new vehicle sales retail to 21% being done by cash in November. And that obviously impacts a lot of profit pools for the business and potentially has the impact of changing behaviors down the line. I mean, one of my theories is it's that lease customer who came in to seeing that supply was coming back and they're ready to lease again. And the lease offer they're receiving in some cases is almost twice what they had on their last lease in 2019. And then they're looking at the average new vehicle loan rate, which is approaching 8.5%. And they're sitting and looking at the cash that's sitting in their account, drawing 2%, and they're electing to finance that transaction themselves. And again, it sort of relates to what are the F&I products we're not selling? How is that changing all the rest of their behavior in terms of their relationship with us? What does that do long term for the loyalty and the expectation of when we expect them to come back? I think there's huge implications for that. And at least in the data that we have, that's really good data about all the details on how things have been financed and how things have happened before, we've never seen this. So we have no perspective of what comes as a result of that move. And I think that that's a pretty significant thing to consider, because part of the selling process might be dealing with the ramification of what looks like an easy sale because a consumer is willing to bring cash, has other challenges down the road.
So those people that deferred their new purchase because they were looking for a better deal have seen a little bit better deal and now they're able to strike with the cash. Those are the people that they could defer the purchase.
Yes, or they happen to be right at the cycle because of timing.
Good, thanks, Paul.
Hey, thanks, Jay, and
that may be the one that was fading out earlier.
is that okay?
Yeah.
Thank you, John, and Jonathan as well.
Very encouraged by a lot of the comments that you made as it relates to. Looks like there's a lot of levers that we can pull in the event that something happens that's negative to the economy. Some might argue, though, that a lot of what we're concerned about is not that it's not going to happen. It won't be a recession. It's just going to be delayed because of all the money that was included in the economy years ago. And maybe that there are early signs of layoffs on a lot of companies, for example. We see construction, projected spending on construction coming down, credit cards going up, savings going down. I guess my question, Jonathan, is what are you most focused on that would prove to you perhaps that we are going to have to start pulling those levers more rapidly to maintain what we're seeing in the environment currently, supply notwithstanding?
Yeah, Jamie had a very eloquent question, but I'll summarize it as what is it that I'm most focused on for understanding which way the economy is going and whether levers are going to have to be pulled in dealer businesses. Was that a decent summary for those who couldn't hear? No, it was eloquent. I enjoyed it. The consumer. No question, it's the consumer. And I look at weekly data on credit card spending to basically see, is there evidence of pulling back? So I would argue one of the challenges as an economist, and I'm sure you guys feel this perhaps even more than I do, that part of your challenge is not just the reality of how the economy is unfolding, but dealing with all of the noise and the nonsense that is basically misdirecting you on what's happening. Because, you know, we got retail sales down, you know, in the data, and we were down in November and down in December. But the credit card data indicates that the consumer did not pull back in November and December. They were just spending heavily on travel and services, none of which shows up in retail sales. They just weren't buying TVs at Walmart, you know, in December. So I'm paying attention to that. Of course, that's directly related to the labor market. And so like your observation of layoffs are occurring, yes, we're hearing those pockets of that, but it's just not materializing and sustaining in the jobless claims and showing up as severe increases in unemployment. The opposite's happening. We're seeing positive job growth. And then I would add the other piece, because it was a theme that was heavily focused on this morning, and I know from talking to many of you that it's absolutely a part of your focus. Pay attention to your local dynamics. Because even if we go into a consumer-driven recession because of the Fed pushing interest rates too far, there are places in the country that are going to experience no recession whatsoever and have very positive population and job dynamics, which means that vehicle demand, other than the challenges for affordability and access to credit, is still going to be rock solid. It's environments like that that produce way more variation. We've gone through 3 years of things being determined by supply, really supply and interest rates, very macro things that are very consistent. But an economic cycle almost never plays out evenly across the US. And I can guarantee you there will be differences on how that unfolds.
Good. John Murphy, the next question is for you.
We had a question over here at this table.
Is it? Okay.
Jonathan, you mentioned a tight used car market this year. Can you talk more about that and also what you see the next 2 years?
Yeah. So looking at the wholesale market, so what Manheim, Odessa, and you know the total sort of physical auction plus all the digital platforms that have developed, we think we've got another decline this year of about 4.5–5% in total transactions, or the flows that feed the used retail market. So if that is declining, it's representation that the availability of vehicles to sell, to transact and use is declining. All of the declines that are expected to happen this year are with vehicles that we say come through dealers. So it's effectively related to declining, a further decline in used retail, so fewer trade-ins on those vehicles. But most importantly, it's all of those grounded off-lease units that this year we will have roughly 400,000 fewer off-lease maturities for you to be able to purchase at grounding at a positive equity differential as well. Those numbers are really the numbers that make the market even tighter. So then when you look at the composition, it means we're going to have a real scarcity of less than 4-year-old vehicles. All of the growth that is potential in used retail is really in the 6+ year-old vehicles, which is not necessarily the domain of many franchise dealers. I also think it's interesting to consider what's happening to the car park. We are now entering the stages of the car park effectively not having grown in almost 4 years, because the amount of new vehicle production and sales we've had over the last 3.5 years is scarcely bigger than the scrappage, the vehicles that we lost. So we basically have a much smaller car park, and that impacts what you can do in used retail, keeping it tight, eventually putting a floor on where vehicle prices are going to go as well. But it also represents a challenge in fixed ops. We may not talk too much about fixed ops, but from an economic cycle standpoint, fixed ops always does well in a downturn because consumers are holding on to their vehicles. It's especially true these days with vehicles very expensive to replace and lasting longer. But to really capitalize on a stronger fixed ops market, given the decline in the car park, you're going to have to potentially expand who you're marketing to basically pull in slightly older vehicles than you historically have in your territories. And the car park is going to dominate us, and the car park's not going to turn around until we finally start to see new vehicle production start to pick up again. But, as we've both discussed, I think John and I are on the same page that it's going to be a few years before we can talk about a 16-plus level of new deliveries.
Yeah, so I was about to start, John, on the next question for you, and you hit some of the good numbers, and this is more about numbers on the scrappage rate that we project, the miles driven, the cost of fuel. How are those? What are you seeing on that? And you want to?
So I think I guess maybe to think about the question more sort of generally, is how do we think about forecasting demand? And I've been doing this for now 25 years, and it's really 2008, 2009 where kind of a light bulb went off in my head where you saw the total number of vehicles on the road in the United States shrink for the first time in history, and you're like, okay, so this is really a cap goods replacement cycle with a consumer overlay. And sort of the replacement demand is, usually, 4 to 5% scrap rate. So if you've got 280 million vehicles on the road, you could argue it's, potentially 14 million units, and we've been selling at that for 21 and 22, and now probably in 23. So at some point we got to have some liftoff. But I think, as Jonathan mentioned, you usually have growth in that fleet. So if you just add 1%, that's 2.8 million units. So that gets you to 16.8. I think I agree with Jonathan. That would be at a lower price point, but that wouldn't be a crazy way to think about to sort of formulating a trend unit level of demand. So we are far below that. I think the challenge that we have right now is that consumer overlay, as Jonathan was mentioning, is pretty crappy. The consumer confidence number, whether you use UMISH or the conference board, is at 08, 09 levels or below. So the consumer is pretty bombed out in absolute terms at the moment, and that's where you get sort of this lower for longer or lower than you think you can ever get on the cap goods replacement cycle to the downside, and then also on the upside where you get the blow off tops where things are really heady on volume. So that's I think that's kind of maybe answers all of that. Gas prices have come down a bit, so they're not too as scary as they have been. Affordability is the key issue, and that's a question of price on the vehicle and interest rates. So those rates are going to come down in the next year or so, hopefully, and pricing will open up as the automakers make less rich product mixes than they have been making, and they'll do that a little bit, and that'll open up an affordability, and that'll drive the market higher. But that release of that pent up demand will come. It's just a question of when and at what price.
So without the volume picking up, and with the lean years of production, what's the average age of the vehicle going to be in the next couple of years?
We're already at 12.2 and counting. It's going to go higher.
Looks like opportunities to sell and service older cars are a place to make some money.
One thing I will say on that that's interesting, and just talking to the automakers. I think there's kind of and this happens on sort of the bear case in Wall Street. People that want to short the stocks who are crazy, if you ask me. There's this view that the good times won't last, and the business will fall apart, and dealers will lose focus on used and parts and service. And the reason I kind of bring those two up is, it's not just you focusing on them. I do think over time, as the vehicle, forget about the complexity of EV and AV technology, just having a connected vehicle, and that vehicle can be communicated to directly, as opposed to chasing down the second or third or fourth owner through your records or DMV records. That iceberg of opportunity, and kind of what Jonathan was talking about before, is getting into these older vehicles. Whether it be on the second and third transaction in selling them or servicing them over time, is something that the automakers want to help you play in. They want to play in the economics too, right? They want to make more money over the life of the vehicle, but that's not something that is, should really be lost over time. And I think people keep thinking, hey, the focus on used and parts and service as new comes back in the next, year or to 5 years is something that the dealers are gonna lose. It's not just the dealers focusing on it. I think it's on the automakers, and I think over time, this gets into a direct-to-consumer discussion and everything as well, but they're really, want to work those vehicles through some channel, and they need you to do that. So I do think that connected car technology, very simplistically, we're all used to, having these little black boxes in our pockets where something pops up every once in a while. Having something pop up on an LCD screen in the car is really not that far into the consumer anymore, and it might be that they're right front, brake caliper is freezing up, whether it be a regen brake on an EV or a regular brake, that kind of stuff, and driving that vehicle back to you to drive fixed ops, as well as potentially more and more capture of that secondary market in a way that exists, right? This is not newfangled stuff of inventing autonomous subscriptions or EV content. This is stuff that exists in reality, and it's being captured by Carvana and CarMax and all these buy here, pay here dealers, and all these service shops that really should be funneled back to you. And I kind of rile Farley up sometimes about this. I mean, like, you spend billions and billions of dollars and have all these fixed costs and create all these great products, and you participate in just the tip of the iceberg of the opportunity. You should be participating in some of those economics, not taking them from the dealers, but partnering with the dealers and going after them, because the right to earn those profits are the automakers and yours, not Tom, Dick, and Harry's service shop on the corner. Anyway.
Yeah, so often we hear that it's really just going to be a grab by the OEM, but who sells it? So you're optimistic that the dealer's going to get the gross from a lot of this?
I think there'll be, you've got stuff like Car Bravo that's going on. Ford's got some stuff going on. You guys are probably more familiar than I am. I think, like with Car Bravo, and GM is trying to do this, I think they kind of stumbled upon it. They don't realize exactly what they're doing, but keeping a car, and I'd love to hear Jonathan's thoughts on this, but keeping a car in network, in a brand can help the resid, I don't know how much, but to some extent, as opposed to, a Chevy getting sold at a Toyota store is going to get a lot less of I would think would get a lower price and not protect the resid as well as it was if it was at a Chevy store, right? So, I think that kind of stuff of trying to keep cars in network and protect your resids is something that's being better understood, and that can be, that could be facilitated by this connected car as opposed to, dumping it into the open waters of the secondary market. I don't know if you've ever seen that, but
And I think as we talk about electric vehicles, where battery health and understanding of that becomes the crucial ingredient of understanding future value, it will become even more significant.
Rental car companies. We had a pandemic. They shed their inventory. They've been holding on to older and older cars because they can't get their hands on production. I don't blame factories or dealers to not sell them for lower prices, which is typically the leasing company's MO. But that is one of the places where when somebody wants to keep this highly intensive capital, and fixed cost OEM business in place, they may direct again back out to some other commercial fleets.
Yes.
Where do you see that?
They have been starved, and they are a key ingredient of pent-up demand that I strongly believe exists. I think some of the window of the pent-up demand got passed because they had no choice but to acquire vehicles in other places. And actually, I would correct one thing. They weren't getting vehicles sold to them from the manufacturers, but I know a lot of the folks in this room actually sold them vehicles at pretty high prices because they were that desperate over the last couple of years. That started to change. The rental car companies had really strong momentum at the end of last year. They're still about half of probably what they would want to buy, and I would say they would line up today to completely replace their much more expensive and older fleet that they're having to manage if they could. But we're most bullish in new vehicle production, allocating more to fleets. Last year was probably the bottom in terms of the lowest of the lows going into that. And that means they're becoming more of a reliable source of vehicles in the used wholesale and retail market again. Actually, 2021 was the bottom of the lowest level of the off-rental sales. Last year actually picked up because guess what? They were on average buying vehicles that were 2 to 3 years old, and basically they realized with some experimentation in 2020 and 2021 that they really couldn't afford to keep them beyond an average mileage of about 50,000 because the maintenance and repairs were eating them alive. And so basically we've settled into a fleet that's being flipped every 12 months. And so they are a good source. It's the most varied. My dad used to have a colorful phrase for this. Every Tom, Dick, and Harry, is represented in what we see selling, and the mileage is much higher than useful. than usual, so more around 50,000 miles.
Well, we got another question, and I'm reading from a board here, so some of you are texting them in. This is specifically identified to Carvana, but I think there are some other major used car retailers that that may be going through some adjustments in their business plans.
So
Any outlooks you want?
the inventory question, I'll tackle that. What happens if Carvana has a bankruptcy? And I like the discussion this morning. I'm not worried at all about the inventory, other than that, representing Mannheim, the question of can the bankrupt auctions sell their own units? I don't know how that quite would work, but roughly we're measuring and estimating that they have about less than 50,000 active used retail units at present. Well, Hertz dumped 300,000 units on the market when we were vastly oversupplied in February and March of 2020. 50,000 units on the wholesale and used retail market might impact prices for 2 or 3 weeks, and then we're back to business. And if anything, it solves near term the lack of supply in the used retail market. So I'm not too worried about it.
Yeah, I think simply, and this kind of goes to CarMax as well. I think the retailers that are focused on nearly new used vehicles, traditionally 1 to 6, 60,000 mile, units have got to figure out how they go older, because you guys, like I said, with the help of the automakers, are going to capture more and more of that, slice of the market. And once again, it's not something that's transitory in the cycle or because of supply shortages. I just think it's structurally the way that they want to help you run the business, and you should be doing it because you can make more money off it over time. So I think they're challenged, and they've got to find a way to go lower and figure out how to produce, maybe with the help of Mannheim, maybe with their own reconditioning facilities, those vehicles that are repped at sort of similar ways that they used to rep a 1 to 6 year old vehicle, because a 7 to 10 year old vehicle is not a bad vehicle anymore. It's usually a pretty high quality vehicle if you can recon it correctly. So I do think that they have to figure out their business model. The other thing is that both of those retailers are relying heavily on credit, and the earnings from credit, as are some other standalone used car retailers, and that market is getting more expensive, meaning their cost of funds are getting more expensive, so those spreads are compressing. So if you were to look at something like a CarMax last year, or in 2021 calendar year, their spreads were 7.9%. So they were earning 7.9% relative to what they were borrowing, in the ABS market. That dropped to 3.9% in calendar year 2022. It's opened up a little bit to 4.1% on a recent securitization, but that part of the business is, earnings are going to come down significantly over time. So there's a lot of stuff that needs to shift in those business models, getting older in the vehicle fleet, and understanding how to retail those vehicles, plus trying to understand how to run their FinCos better.
Okay, thank you. I'd like you to give a round of applause to our two guests.